Inflation refers to the sustained increase in the general price level of goods and services over time. When inflation occurs, each unit of currency buys fewer items, effectively reducing purchasing power. For example, if the inflation rate is 3%, a loaf of bread that costs $1 this year may cost $1.03 next year. Central banks like the Federal Reserve or the Bank of Korea often target a low inflation rate, around 2%, to encourage spending and investment. However, hyperinflation, extreme cases like Zimbabwe or Venezuela, can devastate economies, wiping out savings and destabilizing markets. Inflation typically stems from two primary causes: demand pull, when demand outstrips supply, and cost push, when production costs rise. For instance, post-pandemic stimulus checks increased consumer spending, driving demand pull inflation. Meanwhile, supply chain disruptions raised production costs, leading to cost push inflation. The effects are multifaceted. Wages often lag behind price hikes, squeezing household budgets. Savers see their money's value erode, while borrowers benefit from repaying loans with cheaper money. Policymakers combat inflation by adjusting interest rates or reducing money supply. But these measures can slow economic growth. Deflation, the opposite of inflation, is a sustained drop in prices. While it might seem beneficial, consumers pay less, it often signals economic trouble. For example, Japan's lost decade saw prolonged deflation as aging populations and weak demand stifled growth. Deflation can spiral. As prices fall, consumers delay purchases, expecting further drops. Businesses then cut production, leading to layoffs and reduced wages. Central banks fear deflation more than inflation because monetary tools, like rate cuts, become ineffective when interest rates near zero, a dilemma known as the liquidity trap. Deflation arises from reduced consumer demand, technological advancements, e.g., cheaper production, or debt crises. South Korea's recent near-zero inflation reflects these factors. Falling birth rates curb demand, while automation lowers costs. Unlike inflation, deflation is harder to reverse. Governments may inject money into economies, but if confidence is low, people hoard cash instead of spending. Globally, aging societies like Italy and Germany face similar risks. The key lesson? Balanced policies, stimulating demand while boosting productivity, are vital to avoid prolonged economic stagnation.